Now time for our market guru this week, our global business editor Udayan Mukherjee and myself in conversation with Kenneth Andrade.
Welcome to this Business Today Market Special. I'm Udayan Mukherjee. With me is my co-host Abha Bakaya and the veteran of the stock market Kenneth Andrade, who's the founder and chief investment officer of Old Bridge Capital. Kenneth has been in the stock market for several decades now, and he brings in that wealth of perspective with him. Kenneth, it's great to have you on the show today. When these days with such a powerful rally in the market, when we speak to market participants, we get one of two views. One, of course, is the skeptical one, which is that the market's headed for a deep correction very soon. And the other is that we are on the cusp of a really big profit upcycle after many, many years, and therefore any correction would be just shallow. Which side do you veer to?
I think they are right on both contexts, and I just put it this way: there is a fraud in a lot of businesses out there, and a lot of stocks that are trading out there. And if you just go by the year-ending numbers, which is basically 2021 March year-ending numbers, the profitability metrics are shifted to a very different kind of businesses that are there. So you got market capitalization sitting at one extreme of businesses, and in the other extreme you got companies that are actually making cash flows. To put it simplistically, 2022 March end, if you look at what's going to contribute to profitability of the underlying indices, it's got everything to do with commodities, and they have no representation in the index itself. So I think that's the anomaly. Even if the market does correct itself, which we've seen multiple times before, that market's always correct. I think the leadership is going to be taken away from the businesses that have done well so far.
That's an interesting assertion. Are you saying that the expensive part of the market will actually lead the correction, and maybe other sectors will sort of balance it and become the leaders of the next upcycle, and that leadership will be in commodities? Is that what you're saying?
Yes, I'm saying exactly that, and there's a reason for it all also. And if you look at multiple trends and the multiple ways that investors flock around the best thing in the marketplace, usually you try to justify valuations where they stand. Okay, and today it is price to sales. The world's going to get digitized, and things are going to be very different after the next decade. But how much do you pay for growth? You go back to the 2007 and 2008 beginning rally of commodities and capex. You set up surplus capacities with that market capitalization there, and there you had you always argued for sum of parts and price earnings to growth. And then you go back to 2000 and it was valued very differently. So all bubble cycles take place. Whenever the bubble cycle takes place, you've got a very different approach to trying to justify valuations. And I think that's what's happening in the marketplace today. So whether it's 6 months, 1 year, I don't know how to time this, or we've never been able to time this very effectively. I think that part of the market is going to consolidate. You will have fewer winners come out from there, but the entire leadership is changing. Our sense is, yes, it's going to be manufacturing, which also includes commodities, and a whole host of other businesses where the visibility is fairly high. It's fairly high, and it's fairly high into the decade, not just into the next year or two.
So, I mean, if I were to, you've explained the principle or the philosophy behind your view, but for somebody who wants to take away something from an investing point of view, could you drill it down to sectors where you see the froth? Is it only because there are not too many digital stocks in the market? I mean, you can only name one Zomato, one InfoEdge, etc. Are you also including the very highly priced consumer FMCG kind of companies which trade at 50-60 P multiples? And when you say manufacturing including commodities, are you talking about sectors like chemicals, steel, aluminum, maybe even some of the other exporting sectors? So what to buy and what to avoid? I mean, if you can drill it down to what you're saying in terms of sectors.
Simplistically put, our point of view is that whatever has done well in the last decade, and that was led by a consumer economy and a consumer rally, plus everything that leveraged the consumer cycle, which is essentially the financials part of it, or the lending cycle of the financials part. I think that's going to get compressed in terms of valuations. Those businesses will still come out great at the end of in this next cycle, but you're not going to get a profit expansion or dramatic profit expansion, and that's not and that's also not going to create higher multiples than where they are right now. So that's the place that we are very cautious about. They will do well. Companies' profitability will grow, but I think they're already fairly well priced into it all. What's not really priced is the commodity cycle and manufacturing. So take India's largest steel company, right? Or even take India's largest aviation business. Now, those are companies and businesses that are throwing out enormous amount of cash flow. Or just look at utilities, what's happening out there. Those are the businesses that are throwing out enormous amount of cash flows, but you can actually value them based on our very traditional way of looking at cash flows. All you need is sustainability of that trend for not 10 years, but for the next 3 years. Okay, and if you get that sustainability for the next 3 years in terms of the cash flows that they're turning out, it is equivalent to their current enterprise value or to their current market capitalization. So what's happening with that, with companies that haven't attracted attention over the decade, is that no supply has come in. So it's been ignored not just by investors, it's also been ignored by entrepreneurs or private equity or the banking system. And that's created a supply crunch in the system, and demand still chugging along. So if you look at the supply demand economics, it's very much favorable to everything that we see doing well right now in terms of manufacturing, commoditized businesses, okay, some element of services businesses, real estate. Okay, I think we could be heading into a fairly long-winded cycle in a lot of these things. Simply because we're not looking at 10-year visibility, even 3-year visibility explains their current market capitalization.